Yeah, so I initiated on Booktopia at the start of the week. That came out with an ad rating and a 317 price target. That's 13% upside from where it's currently trading. It was about 22% when I initiated. And if I'm honest, I've probably been a bit conservative on the target price and valuation there. But you'll probably know what Booktopia is. It's a leading Australian online book retailer. Now, 75% of their FY20 revenue was from repeat customers, which is the highest of kind of e-commerce comps that I look at in the Australian market. They grew revenue by 28% in FY20, and I've got 26% growth in FY21. So that's just above prospectus. So the top line's growing quite well. There's really two main reasons to own Booktopia. And one is continued share growth of kind of a $2.6 billion book industry. I guess one of the good things about, if you can have a good thing about a failed IPO process 4 years ago, is that we get to see their forecasts and what they were thinking longer term. And they've basically hit every metric that they had enunciated at the previous IPO process. They've grown their market share from 2% to 6% over the last 5 years. Some of the work that I did in the IPO, in the initiation process there showed that they've got a really price competitive offering, and they're really well liked by customers. Delivery times are quite good too. So we see them continuing to gain market share. Some of the capital that they've taken on pre-IPO and during the IPO process will also help alleviate some of those growth constraints that they've had too. So my forecasts imply kind of a 9.6% market share in FY23, so that's from the 6% currently, out to 13.5% in FY26. So that share increase is basically coming from increased penetration of online in book sales, and also them growing ahead of online as they have over the last 5 years. The other part of the story is really operating leverage. Now, this business hasn't really shown much operating leverage over the last kind of 5 years in their history. A lot of that's been because they've been capital constrained. So I have margins improving this is EBITDA margin I'm talking about, from 3.6% in FY20 to 9.6% in FY26. Now, some of the work I did in the initiation showing that versus comparables, etc., that's where the comparables are around at the moment. The company's aiming for 10% plus, so maybe I'm being a bit conservative there, but I really think that they can get that margin up. And a lot of it's to do with the CapEx. They're spending $20 million CapEx on their distribution centre. So they're basically swapping out CapEx for OpEx. The first part of it is to really increase the back end ability to get books out of the system. They were constrained at about 30,000 books per day. They're doubling that to 60,000, and by kind of FY24, they're going to have that increase to about 100,000. And the second part is really automating the DC. They've still got a lot of manual processes in the DC. And again, that's because of the lack of access to capital that they've had. They've basically been throwing extra shifts and extra labour at their growth. Now they're going to be able to reduce a lot, well, not reduce the labour, but to actually, have the labour a bit more efficient by automating a lot of the back end there. The other thing it does is also gives them a lot more space when they start automating. And space is imperative because it allows them to house a lot more inventory. So at the moment, they've got 140,000 titles that they house in inventory. They're looking to eventually move that to around 200,000. And what that does is when they've got a book on site, in stock, so in inventory, and consumers know they can get it within kind of 3 to 4 days, they sell 4 times more of that book. So, reducing the tail of inventory they've got will really help there. The other part of the investment thesis that I really like is this Booktopia publishing services business. Now, it's really a fledgling part of the business at the moment, but the main part of that involves distributing books for publishers, for authors and for publishers. So what that does is, they basically utilise their existing infrastructure to do that. So there's not too much extra fixed cost leverage involved in it, and they also get the titles at a lot cheaper, wholesale rates than what they would normally. So that actually strengthens the consumer proposition too. So we see that as a really good growth aspect going forward, and that'll probably grow ahead of the core consumer business. So on the metrics I look at, so EV to revenue and EV to kind of gross profit after paid acquisition costs, this thing is trading at about a 30% and 40% discount to the peers, even after kind of the re-rating after the IPO. So I think it's attractively priced. So if I'm looking at Booktopia for your clients, I kind of see it as a less risky way of playing this, continued growth in the e-commerce thematic. And the reason why I think it's less risky is because it has less cycling risk. One is because, the nature of book purchasing, it's a more a repeat purchase. So it's more of a staple than, say, homewares, etc., which might have got a one-off benefit. The 75% repeat customer rate, so they've got a lot of repeat customers coming through just buying constantly. The stuff I talked about, alleviating growth constraints, so they probably haven't grown as fast as they could have last year, so that'll come into the next couple of years. And then also a lot of publishers during COVID kind of held off releasing new titles, and these are all coming through at the moment. So I think, this is a lower risk way to play the kind of e-commerce bet for your clients.